Whether it's Social Security checks, investments, Medicare premiums, or other tax-related issues, older Americans need to understand what's a tax opportunity and what's a tax trap.
And joining us this morning is Chris Orestes, president of Retirement Genius and an authority on retirement planning, long-term care, and financial health. Good morning, Chris.
Great to be here. Thank you.
Thank you. Okay, so we're going to be playing a tax game. Is that right?
Yeah, if anybody can consider taxes game, but this is as close as we can get.
Good point. Okay, so when is Social Security taxed and when isn't it? Or is that the part you're supposed to say?
Well, a Social Security can either be a tax or an opportunity, a tax trap or a tax opportunity. And here's what people need to be aware of. And too few people realize that when they turn 65 and they're still paying taxes, that there's some differences to what they were used to in the past. So a good example is Social Security, and it can be a tax trap. If you're making income while you're collecting Social Security, your Social Security benefits can end up being taxed if you're making above a certain amount. And in 2022, the income limit is $19,560. So if you start making money above that number, you'll end up getting taxed against your Social Security benefit.
All right.
All right, here's the next one. Is it possible for seniors to deduct from their taxes the amount that they pay in Medicare premiums?
Here's a tax opportunity, not a tax trap. If somebody is on Medicare, they can deduct what they're paying in premiums if they're self-employed or they're not eligible to be on any kind of group coverage. So there's a tax opportunity to deduct what you're paying in Medicare premiums based on your employment status while you're on Medicare.
And when it comes to investment income, what are the tax advantages to being 65 or older, Chris?
Well, when you're getting any kind of dividend payments, interest payments, or you're taking any kind of capital gains, your capital gain rate or your tax rate for interest and dividends, that kind of income, is 15% when you're 65 and above.
All right, how about long-term care expenses? Is there a tax opportunity there?
There's a big time opportunity there for long-term care expenses. Whatever you're paying in costs for assisted living, home care, nursing home costs, anything like that can be tax deductible. Also, if you're providing care to a family member, there's the potential that you'll get tax credits and tax deductions based on what you're providing for care and what you may be spending out of pocket. Also, another area that's a great tax opportunity when it comes to long-term care is if you own a life insurance policy and you want to sell it, which is known as a life settlement, those proceeds that you would get for selling off your life insurance policy can be tax-free if you're in need of chronic care. If you have chronic conditions and you need long-term care services, all that money could be tax-free as well.
Wow. Retirement accounts, opportunity, trap, both. Which one is it?
Well, there you go. Very, very good. They're both. When you're putting money into investment vehicles like 401ks, IRAs, you're at a tax advantage. 401ks, when you're putting money into that money's coming out of your paycheck, and that's pre-tax dollars. You're not being taxed on any of those dollars that are in your paycheck. So it's a great opportunity to really increase your savings because you're putting money away before the government even taxes it. So when money's in a 401k or it's in an IRA, that money grows tax deferred. So it can sit there growing without you having to pay any taxes on the growth of that money as it's increasing in value. But there are traps, and you got to watch out for this. If you take money out of those accounts while you're too young, below the age of 59 and a half, you could be subject to a 10% tax penalty on top of the income taxes you would pay for the money you took out. Also, there's a point where you have to start taking money out of those accounts when you hit the age of 72. It's called a required minimum distribution. And if you're not taking out the amount every year you're supposed to, whatever you didn't take out that year that you were supposed to take out will be hit with a 50% tax penalty.
Ouch.
So you got to make sure you're managing your accounts correctly. Don't take money out too soon, but also don't wait too late to start taking money out either when you're getting older.
Okay. Excellent advice.
Yep.
Chris, thank you for joining us this morning.
Absolutely.
Have a good
Tax
one.
time's coming up. Everybody be ready.
Certainly is. Thanks.